So first, let me introduce the first panelist we have here, Andrew Grant. Andrew Grant is our Director of Portfolio Management, a tremendously powerful force behind our team to make sure that the investment philosophy of IDA is executed and implemented into our strategies for all of our clients. Critical and unique and interesting role Andrew gets to play is he gets to triage the various personalities of our advisors, which is no small feat. If you ever go to our website, by the way, and you hover over a picture of one of our team, you can see we have little personal pictures behind it. So there's Andrew, or someone who might be Andrew, because look at that form. I don't know, shredding some snow out there somewhere. Where was that, Andrew?
That was in Alta back about 10 years ago.
Skiers only, huh? Okay.
Yep.
And then we have Jim Pupillo, one of the founders, managing director, head of our Scottsdale advisor team. Jim's been in the business for quite a while and is a formidable force as well in helping shape the investment committee philosophy. And he's going to have some great discussion points today to cover. Rick Labrum, another founder, director of wealth management. Rick Labrum is the godfather, we like to call him around here. There's so many stories. I'm not even going to try to begin, but hold on, let me go back to Jim for a second here. See there's Jim on his horse. That's awesome. Jim, is that your horse?
No, it's not. That was up in Keystone at a conference and got to go horseback riding.
That's
that
awesome.
afternoon.
That is cool.
But good style, and the hair and the style there, it all kind of flows, doesn't it?
Yeah, I don't know whose mane was longer, the horse or mine.
I think you got him, Jim.
And then we've got Rick there with the family. Oh, that's a sweet picture. Rick, who's that with you?
That's my wife and my granddaughter.
Oh, that's what it's all about, huh?
For sure.
Awesome. And then last but not least, Jason Labrum, our fearless leader. There's Jason. That doesn't look like you though, Jason.
Come on.
That guy's got a lot of hair.
I had brown hair and a full head of hair.
Where was that?
That was Indonesia at a place called the Macaronis in the Mentawai Islands.
That's awesome. Those are our panelists, everybody. Lots of personality, as you can tell. We're going to tackle some of those topics that we put out there in the invitation, and lots of questions. Please bring them on. With that, I'll turn it over to you, Jason.
Perfect. Thank you so much. It looks like we have just a great turnout. We were so excited to see so many people register, and it just gives us an opportunity to take the message that we continually not only instill internally, but also talk to our clients about and our prospective clients about, but to do it on a broad spectrum where we have a live forum of open questions after. And I think this will be just a great environment for us to share what we do and what we're thinking about as a firm and how we're operating. So thank you so much. I even got nervous today. I mean, I was a little nervous before this call. I don't normally get nervous. I don't know why I got nervous. I guess maybe it's excitement. I don't know, but I'm feeling the flow right now. So, IDA as a firm was born in 2009, and it was born out of, I spent 6 years at Merrill Lynch, subsequently 6 years at Smith Barney, had 5 business cards at Smith Barney. It turned into Morgan Stanley as I left and started, and Rick left as well and joined in starting our firm 10 years ago. We had 120 million in assets under management, and it was really Rick and I and Jordy who joined us at the beginning. And that firm has turned into now 21 people and over 1.1 billion in assets under management. And it has been certainly fun and exciting, and it's been also a great learning experience. We continue to learn and try and do better, but hitting a couple big milestones in the business, is when you starting your own firm. That's obviously a huge milestone because we now get to serve clients, and since 2009 we get to serve clients the way we want to serve clients, the way that we believe is in their best interest. We get to serve clients as full-time fiduciaries, which I'll talk a little bit about in a moment. But that was a great milestone. And I always said to myself, if we could do have $1 billion in assets under management and serve 1,000 families, that would be unbelievable. And we're here, and we hit that milestone. One of the things that we have always promised when we talk about who we've become as a firm is that we will absolutely stop growing, 100% stop, if it means that we're going to sacrifice the service to our existing clients. We will not sacrifice the service to our existing accounts and our existing clients who've given us their trust and confidence in order to continue that growth. So much that when you look at, this is a table tent we all have on our desk that talks about, if I can zoom it in there, it talks about our values, and it has our purpose, and it has our vision here. And one of those things that I think is worth pointing out while talking about the service we provide to our clients is the fact that we want to be one of the best places to work. So we want our employees to be happy, engaged, and loving what they're doing, and everybody who works here. But we also want to have what's called a net promoter score that exceeds the industry's average and it actually sets the standard. That is, net promoter score is a way that we measure how our clients are happy, whether they're happy or not, whether they like what we're doing. So I'm happy to report that not only have we grown the firm and served more families, but we've also been able to increase our net promoter score measurably over the years, and we have a goal to continue to improve that. And I stress that just because I don't ever want to talk about what we've done as a firm and have a client sitting there saying, well, did I just become less important? Am I just now a smaller piece of this puzzle? And again, we're not going to grow if it means that any existing clients are going to become less important. So I want to encapsulate that by the fact that we are able to serve our clients as fiduciaries. And the term has been abused and misused in our industry now for several years. And the term fiduciary to us is near and dear and very important. It means that we are operating under a full fiduciary obligation to serve our clients' best interest. You would think that most advisors, financial advisors, stockbrokers, whatever these people are called, we're all called nowadays, that we would have to do that. But the latest numbers we've seen suggest that that number could be as low as 5% of advisors in this country are people holding themselves out as financial advisors of some sort. Less than 5% of those operate under the full fiduciary standard, meaning they're constantly and always legally bound to act in the client's best interest. So that's a pretty special position that I think IDA is in, that we not only hold ourselves out publicly, that we're going to do what's best for our clients, absolutely 100% of the time, but we're in a pretty small group of firms that do that. So we're happy to do that and excited that we can say that and hold our heads high to serving our clients' best interest. I think it's important, and one of the things that happens every time we're on a phone call with clients is we talk about our investment philosophy. We then talk a little bit about our strategy, and we talk about how we implement that. And I think it's really important to start this conversation because we get so many great questions from our clients and prospective clients about what are you doing in light of the blank event? Maybe it was the COVID decline last year in March. Or maybe in 2016, where we had one of the worst starts to the market ever in the history. I think it was 16. That the markets. What are you doing to help us? What are you doing to protect our portfolio in light of the new event? And so I'll briefly state this. So our investment philosophy in general is that there are traditional markets and there are non-traditional markets. Sometimes we refer to non-traditional markets as alternatives. Traditional markets, we believe, by and large, they're quite efficient, meaning the information is exchanged almost instantly, and the price of stocks and the price of bonds is pretty much accurately represented by the actual price because information is known and all the people buying and selling that stock make the price. So we believe that if we develop portfolios that give us exposures to stocks and give us exposures to bonds, tied to a client's financial plan, that we can, and we're globally diversified, that we can extract rates of returns out of the market and do extremely well. And we don't have to play the guessing game of should we be in, should we be out? What about this event? What about this event? What about the election? What about, you can name the 10,000 different questions that we all ask. By developing a great academically supported, historically evidenced portfolio that's globally diversified, we know that over time we can have a very peaceful, enjoyable journey and we can accomplish great things. So that's by and large the big picture investment philosophy. But then it comes down to strategy. So how do you do that? How do we as a firm come together, put the collective knowledge of our team into one thinking unit, one think tank, and come up with strategies for our clients, from every client who's capital preservation and totally conservative to clients who are aggressive growth. And we believe that that strategy is best implemented by finding out there's certain groups of securities, stocks and bonds, that exhibit characteristics that prove to have better returns and lower risk over time. We call those factors. You may have heard us talk about those. So we believe that we can build a portfolio with global diversification with tilts towards these factors, and we can extract returns out of the market in a really great way that ultimately provides our number one purpose, financial peace of mind for clients. How do we provide true financial peace of mind? Where we don't make mistakes by timing the market, trying to get in and out. So we're building a portfolio around these factors, certain characteristics of stocks that exhibit great risk return characteristics. And then finally, what we're doing on top of that is we're looking at the global macroeconomic environment, which we'll talk about a bit today, and we're tilting that portfolio. So when our clients have asked, what have you done for this or that? We've already made a change, probably. We've already made a tilt, or we've already trimmed a portfolio because one position got too big. And we also are thinking about big themes, lastly. There are some global themes that are in place that, for example, technology. We seem to be in one of those once every 25 years or so, a technological almost revolution where things are changing. It's an exponential change in technology. So that's a theme that we think has been in play and will continue to be in play for a bit. In the medical space, I think directly correlated to technology, you see a theme happening. So we'll add a little bit of extra exposure to those particular themes. So just to recap that, philosophy, big picture, markets work. They do a great job. You can have great rates of returns. You can have a peaceful journey while getting rates of returns by being broadly diversified and have a great asset allocation. Secondarily, we find groups of securities that exhibit great characteristics that provide better returns and lower risk over time. And lastly, we think about the global macroeconomic environment and any particular themes that are in play. That is our investment philosophy, our strategy, and the implementation of that. And I think it's important that our clients and prospective clients hear that, because I started the Financial Detox and wrote the book a couple of years ago, and that's our show and our podcast. The biggest mistake people make when it comes to investing is behavioral blunders, as Nick Murray stated in a book called The Excellent Investment Advisor. People make behavioral blunders because they allow emotions and headlines and events to detract them from an investment philosophy. So we at IDA want to help our clients never make those behavioral blunders, have a peaceful journey, tie all of that to their specific purpose. Like, what is your financial purpose? What is money for? What does it mean to you? What does it mean to your family? Is it philanthropic? Is it about experiences? Is it about saving and creating a bigger nest egg? We don't care what that is. We just care that we understand it and we know it and we can help you achieve it. Yeah, it can be any one of those. And then we want to help you make that become a reality through not making investment and behavioral blunders around investing, and so you can succeed. So that's really
awesome.
That's really all I have. Sorry, I went longer than I wanted to, but
that's
I
okay.
tried to make it encompassing.
You got it started, and it's awesome. There's a lot to unpack there. The first group of questions we've been getting throughout, I mean, it's throughout every year really, but especially this past year, right? And Jim, I want you to attack this one first, if you will, and then we'll bring it to whoever wants to step up next on the panel. But the question sounds something like this when asked by anyone, is how do we feel about the current state of the stock and bond market? Super broad. So Jim, wherever you want to start, how do we respond to that?
Okay, I'm going to go broad and then I'll try to narrow it down a little bit. But certainly there's been a sizable shift in government policy and what's not only happening in this country, but around the world. And I think one of the messages I'd like to leave with the group is that regardless of policy, there are always winners and losers. And to Jason's point, there are always places to find opportunities to make money by being invested, whether they're having different factor exposure or different sector exposures. So that should entice everybody to get away from the mindset of trying to market time. We don't need to market time. It is mathematically, it is not justifiable. And it's not market timing that matters, it's time in the market that matters most. And also to reiterate what Jason said, it starts with a planning process. What we need to do is we need to understand your balance sheet. We need to balance your balance sheet. We need to understand what your living expenses are to get to the lifestyle you desire to be, or the lifestyle that you're at and you are very interested in maintaining. So this gets down to balancing the balance sheet. And so if we can identify those expenses, which is what we do in the planning process, and then we take inventory of the assets that you have to be invested, our exercise is to determine how to optimally invest those assets to have the highest probability of funding your expenses and doing it with the least amount of risk. And Alex, if you have that one chart, while I'm speaking, you can bring it up. I think a picture is worth 1,000 words of the asset allocation diagram, or the liability-driven investing diagram. But so everything I said, taking inventory of your expenses and taking inventory of your assets, we all know that those are very dynamic. Your expenses change, your assets, we know that assets change because markets go up and down. And let's say, for example, if you have a need for a 7% target rate of return to be able to get to your lifestyle or to maintain your lifestyle, then that's what we need to be focused on. It's not what kind of return did the S&P generate, because that has nothing to do with your goal completion or maintaining your lifestyle. What we want to do is keep you on course to being able to fund those expenses. So if the market goes down and you have to go from a 7% target return to an 8 or a 9 to get you back on track, that's what we do. And you see what this does? This takes the emotion out of investing because it's mathematical driven. You as the investor come to the same conclusions. The conclusion is do I want to increase my growth exposure to stay on track? Or do I want to cut my expenses? Well, when we go through COVID-like events, we can find, what we observe is most people don't want to change their lifestyle. They don't want to cut expenses. So we do increase growth exposures, and then we're able to, get back on track and then perhaps go back and take them off. So this process of balancing the balance sheet is what works. So
what about, getting more direct? Because we're getting questions from clients and attendees like, so are we at an all-time market high? And if what does that mean? How do we answer that kind of question?
Yeah. So unquestionably, there's much stimulus spending going on from our government. And there's potential for infrastructure spending. There's pretty echoed that there's going to be continued quantitative easing. What's quantitative easing? That just means our central bank, our Federal Reserve's ability to lower or raise interest rates. And they've certainly have signaled that they're going to keep interest rates down. And that seems to be echoing across the global central banks as well. We have a strong consumer and business balance sheets. A lot of the stimulus checks, and we all have heard that a lot of the COVID stimulus went 9% of it went to COVID relief, but there were certainly people that needed it. But what's happened is people are paying down debt and people are saving more. The savings rate in this country is usually somewhere around 5-7%. It was up to 14%. And now I'm certain that I heard that it's actually as high as 19%. That's incredible. And that's why the Home Depots and the Lowe's of the world are doing so well. And this gets back to the winners and the losers. We went into COVID and the winners were the Netflix and the Amazons, the Home Depots and the Lowe's, because people were saving money that they would have been spending on vacations or going elsewhere. Certainly that leads into who the losers were, the hotels, the airlines, and so on and so forth. So we have an economy, especially with the euphoria around the pandemic ending with vaccines, that not only in this country, globally, that we can have potentially an economy that will be very robust and can be multi years in that growth cycle. We certainly can't be cavalier. We have to be cautiously optimistic. We have to look at what this quantitative and stimulus spending and policies are going to mean from a standpoint of inflation and tax increases and things like that. So those are items that are on IDA's radar. We're not going about this with blinders on, but where are we today? Let me just kind of get to some of the key takeaways for you listeners. We have we've lightened up slightly on our equity exposures. We have decreased our domestic US exposures in favor of some of the international exposures. The international valuations are very attractive, particularly in what are called value stocks versus growth stocks. What are value stocks? Value stocks are the old industry, such as industrials and manufacturing, financials and energy and traveling and hotel and airlines. These are the companies that have been left behind for an unprecedented long period of time of almost like 10 years. And we're starting to see, as we come out of this recession due to COVID, that those are the companies that are starting to do well again. And so it's a cyclical, what we call a cyclically led rally. And the valuations are attractive. There's still reasons to have growth exposures because of some of the comments that Jason made about technology. Technology, it's unprecedented, the productivity and what it's doing to enhance our lives. And then we do have some exposure, obviously, in fixed income, and there's some sectors in fixed income that look very attractive as well.
So Jim, thank you for that. That's excellent. I think what I'm taking away from it, and I'd love to hear maybe one other panelist interject, and then we'll probably move on to the next topic for the essence of time. But I'm hearing optimism, which is something that even last year, I mean, maybe Rick or Andrew, how do you answer this? Andrew, your answers are more directed towards the advisors, our advisors probably. Sometimes clients, I know, when we bring you in for some more technical related inclined clients, which is great, and we appreciate that. But maybe Rick, how do you answer that question when a client asks you? And a client asks it a lot of different ways. But hey, Rick, every time I turn on the news, the market's at an all-time high. Should I really be investing the money I just sold, got from the sale of my house or my business or retirement, or what do you think about that?
Thanks, Alex. Well, the first thing I think is turn the TV off. Yeah, that's the because the thing that drives the day-to-day volatility that we see on the news every time we turn it on is emotion. I mean, it's the buying and selling, and every time someone sells, somebody buys. And we have to, Jim talked about this, we may have to change our strategy a little bit along the way. But I mean, we learned this last year. It was a perfect example. We came off of 2019 and everything looked great in January. And by the end of March, we had seen the equities fall 35%. So if you panicked then and you jumped out, then you missed the next 40% or 50% run in areas that did very well, because there's always goods and services trading places in our economy, in the global economy. So you can't move with the day-to-day emotion. You have to have a plan. When that's in place, then you stick with it. You make small adjustments along the way, and we do that for the clients without even being told. So, yeah, is the market at the top today? Maybe it may not be, but it doesn't really matter unless you're selling today or buying.
It's almost like you were perfectly queued up for your next bullet point, which is lessons learned from last year, right? Let's tackle that one while we're on it, Rick. What other lessons, what other wisdom do you want to impart?
Well, I know Jason started to say something there. I was going to give him a couple more minutes.
No, I don't even need minutes. I just think that you made such a good point referencing the most recent experience, right? Because, Rick, you've been in the business for 30-something years, Jim 30-something years, me 23 years, and we've seen every year, on average, the market goes down at least 14% at some point during the year. That's the statistical fact. So at some point during every year, there's reason to panic, there's reason to shift, there's reason to change your strategy. What we're trying to get across here is that you don't have to have this guessing game and this Vegas mentality in order to have a good experience. In fact, you can have a better experience by staying the course, not ignoring all things, right? We're constantly tilting and tweaking and fine tuning, and like a guitar comes out of tune eventually. You have to fine tune it. We're constantly doing that with the portfolio. And then last, Rick, I think you made a great point. And you look at some of the clients that we have 1,100 or 1,200 clients. almost exclusively, they followed our advice last year during the big decline. There were a couple, unfortunately, that we weren't able to save. And we call it saving because we're trying to save people's financial lives. And they couldn't handle it. And they bailed out. And they shouldn't have, because they weren't as volatile as the stock market. They had a great financial plan. They were still intact. And those people financially really hurt themselves. Now, we still love them. We're still trying to coach them back in and get them back on track and get back to the purpose of their life. What's your financial purpose? But there's real damage being caused by not having a philosophy. So that's all I wanted to say. And we have real stories that mean a lot to us, because it's terrible when we're not able to guide a client to the right decision ultimately. And it doesn't happen very often, thank goodness. But when it does happen, it's heartbreaking.
I'd love to hear from Andrew on one piece, and then back to you, Rick, for this part, because it is yours. But there's a piece of this that I think it's important, and we haven't heard Andrew yet, so I want to hear him talk about. This is a lesson learned, but it's a lesson we already learned and how we actually did it last year. Andrew, do you want to talk about this a little bit? And because you're the technician behind it, maybe you and Rick can go back and forth on this a little bit. It'd be fun.
Sure, absolutely. So we implement tax loss harvesting and tolerance band rebalancing, which were two kind of key operations last year within trading, right? Tolerance band rebalancing is where we have equities that may have had seen a low down 35%, and bonds that have seen a major run up, like back in last March and April. Right. So right there, we are going to naturally trim the assets that have done really well, which was the fixed income portion of the portfolios, and then add to equities. So essentially, you are, buying low and selling high. So as we follow that process day in and day out, we hope to add incremental performance for clients and to help them stay invested in the markets when they are ebbing and flowing.
How easy is that to do as an investor? Like, if what do you think? Anybody who wants to answer that one?
That's where, again, so that's where the emotional part of it comes into play, right? It's selling is always the hardest thing to do, right? It's what makes it easy for us is the emotion is stripped out of it, right? Going back to what Jim said, it's math, right? And when something reaches a certain point, it is time to trim. And when something reaches a different point, it's time to buy, right? Based on our criteria. So
I love that everyone is seeing you, because by the way, Rick, I want to hear you on the emotional part, because I don't know about you, but for me, I was very emotional last year. It was not that objective. It was hard.
Well, Alex, I've been emotional since the late 60s. So that gives you an idea. Just a quick example. 72, 73, oil embargoes. Market goes from the Dow Jones average went from 1,000 to 500 in 24 months. I actually thought they were
really dating yourself there.
Yeah, I thought they were going to discontinue Wall Street. Most of these young people weren't born then, but as we move along, we got into the 80s and the 81s. Interest rates went to 20%. 87, the market fell apart. 92, it fell apart globally. 2000 through 2003, difficult time. 8 and 9, and now here we are with the pandemic this past year. The emotion will drive you crazy. Have a plan, have a strategy, and that's what we learned very quickly last year. Like Andrew just addressed, the tax loss harvesting. When the market drops 35% in less than 4 or 5 weeks, most people don't even get an opportunity to panic because they hadn't seen their statements possibly. But then what we looked around, what was that, Andrew? Another 5-6 months, and we were back past the previous high.
Yeah, so, the trailing 12 month is pretty crazy. When people started to look at some of their statements, there was a 70% from trough to peak right now. So those are real numbers. And like Jason was saying, trying to save people, those are life-changing events. By getting out of the market end of March, beginning of April last year, right, and missing out on a potential upside like this, those are life-changing events for people.
If I could add to that, and you take this long-term approach, because this money is to be used throughout your life expectancy, market volatility really can be viewed as an ally, because when we had these dislocations of pricing, there represents and usually brings about many opportunities, whether it's hotel, airlines, as in a recent example. That happens all the time. So the one thing that I think is really important, to stick to the discipline of balancing your balance sheet, keeping the portfolio designed to achieve the targeted return you need to either obtain that lifestyle or to maintain that lifestyle. And when we have these disruptions in the capital markets, those are the times where pricing gets dislocated. And that's when the opportunities are presented for us to be able to be opportunistic and be able to generate returns and do that in a very risk-controlled manner.
What about
I want to ask Andrew, just one second, Alex, too.
Yeah.
Andrew, I think it's worth talking about how this, because this chart is being displayed right now, this tolerance band rebalancing. You all know I could talk about this for 3 days and everybody would literally disconnect from the call, so I won't do it. But this is something that's done daily. So when our clients ask, what are we doing in light of blank? Oftentimes the answer is, well, we already did it 6 months ago, or we did it 3 months ago, because equities increased so much prior to the prior to the COVID crisis downturn. We were trimming profits out of equities that had done really well. So if you look at this chart, and I'll be brief, but look at like US large cap growth as a target of 28% with a maximum position of 32.48. We are literally scanning every client's portfolio every single day. Is that right, Andrew? I don't want to say something that's not true. Every day, scanning every client's portfolio to see if they have breached the minimum or the maximum. So there were times back, I can guarantee you, and it happened, there were times in February, early February, January of 2020, where we trimmed equity because it had passed the maximum tolerance band. Then comes the downturn, and then the price goes way down. We hit the minimum and we're adding back to it. So we're not just sitting there saying invest and don't do anything. We're doing something every single day, evaluating your portfolio with pinpoint precision to make sure that your target weights, your minimums, and your maximums are all in line. Sorry, that's just an add-on. And I mean, it's every day, right, Andrew? This is your job at our firm. We hired you because we wanted to be precise in doing that.
Jason, yes. I've got a quick story, and I'll make it short, Alex. But
oh, these are great. Keep them coming.
I called Andrew. Well, I was going to say that's why Andrew lost all his hair. He used to have an Elvis Presley look a couple of years ago. But I called him, just a brief call. I was all upset. I had pulled a client report off that was up, the trailing 12 months was up like 38%. And I said, there's got to be something wrong with these numbers. And he said, Rick, take a deep breath. You remember we had a major sell-off. We bought things. So the returns look extremely, they're out of whack with what we normally see. But that's just a perfect example of staying in the game. You keep driving along and you have a smooth trip, even though the market's bubbling around underneath you. You just have to stay the course, and it pays great dividends. Right. That patience.
And in a growth portfolio, there's numbers right now on 12 months that are 70%. Yeah. I mean, they're crazy, and that's just the reward for staying put.
So guys, a little bit of vulnerability on this next question. Same topic still, and then we'll move on in a moment. But what about lessons learned from a compassion standpoint, communication from an advisor to a client back and forth? What do we feel? What do we want to share on that we learned last year? Even those of us who've been in the business for 20, 30 years plus. I mean, what did we learn last year that we could share with this group? And again, kind of show people how we continue to try to be better for them.
History doesn't necessarily repeat itself, but it rhymes. So what we experienced last year, Rick gave a bunch of other periods of time where we've had, again, the same kind of experiences. So not to sound like a broken record, but it's really important to stick to the discipline and stay the course for your goal completion.
Alex, are you talking about are you asking a question more along the lines of the financial planning process and just being compassionate towards our clients and the fact that the emotions are real? We always talk about take the emotions out, and we mean that from an investment philosophy standpoint and how our implementation of our strategies But we don't mean that being dismissing our clients' emotions, because we know we're investors too. We know that it's important to sit down and to talk and to listen and to revisit the plan, because there's a purpose behind all this, right? This is not a game to try and beat an index or beat a this or beat a that. This is about creating the best financial life you can create, avoid mistakes along the way, have a pleasant journey, and sleep every single night with true financial peace of mind. Our very, very purpose says to steward financial peace of mind for all of our clients and as many people as we possibly can. And
that's along the thread of where I was going with that, because the questions that I'm getting around this topic, at least, a lot of them have to do with a famous quote, failure is the best teacher. So what did we learn from those maybe half a dozen clients that we actually were not able to save? That's where you learn the best lessons, is when you experience some failure, right?
Alex, I believe that I think it's critical to, we constantly talk about how great we did here and how great we did there. I think it's even more important to talk to our clients and just tell them right up front. I mean, there's going to be difficult times. We are going to be stressed out. And to say that we strip away the emotion, we attempt to do that, but believe me, I'm emotional when I see portfolios going down, including my own.
Andrew.
And it's so I think communicating more to our clients and helping them understand this isn't easy, or we'd all be doing it. It's a difficult, challenging experience to invest for 15 or 20 or 30 years and hit those targets like Jim was talking about. Because that target isn't just a nice straight line and an enjoyable ride. We can make it comfortable by preparing ourselves mentally to accept the fact that things do change, but there will always be goods and services and demands for those things. I mean, everything from air conditioning to food and water and shelter, somebody's going to provide those things. And so there will be opportunities, and usually the biggest opportunities come at the most difficult times. So
that's awesome. Thank you. I think we're 39 minutes in. The next bullet point, which Andrew will start us on, is definitely the one where there's the most questions around. So you're welcome, Andrew.
All right, thank you.
This is a look to the future about topics that are coming up more than ever before, like inflation, cryptocurrency, and alternatives. So
yep, great. I'll start. Yeah, I'll start off right in line with inflation. So let's talk about what inflation is, okay? Just in a very broad, simplistic way. It's too many dollars chasing too few goods, right? It's supply and demand issues. I think what we saw last year was this issue of COVID, obviously, right? And the pandemic has sort of created an issue surrounding goods. We saw the service sector very much drop off, that being hotels, that being airlines, lodging, you name it. Services have dropped drastically and have been replaced by the need for goods. I think everyone knows they probably had a hard time finding toilet paper last April and June, right? I think you saw price spikes in hand sanitizer. I think these were shocks to the system that were very much due to COVID, right? And then what did we get in response to that? We had massive liquidity from the Fed. They just dumped so much money into the system, and that money basically went to work to buy goods, really, right? To buy food, to buy energy, not so much gas and oil. And it's actually interesting when you think about inflation. Last year, we had a negative oil contract print of negative $25, and gas, I think when you're putting gas in your car, it was still $3. How is that possible? Now we're at $4 and oil's, kind of hovering around the $60 area. So the Fed, as Jim had said before, they've reiterated their stance to keep rates as low for the coming future, right? And what does that mean? That they're going to continue to provide this liquidity for everybody, right? So that people are able to continue to get back on their feet. Businesses are able to go, lend, to take money out, right, at low rates. This causes an issue for inflation, and we're starting to see that creep up a little bit. And the Fed has said they are comfortable with allowing inflation to run a little hot right now, right? Typically, target inflation is about 2%. which puts real rates, right, at about negative 50 or 75 basis points, right? The 10 years at 1.5, and if inflation is at 2, you subtract those together and you're actually getting negative return, right, based on rates. And we've seen the 10-year really move up quick here. And that's not due to the Fed, right? That's a lot of that has to do with trading. A lot of that has to do to the, as Jim was talking about, the cyclical trade, right? The reopening trade. And we're starting to, again, to see inflation rear its head, and we're seeing that with earnings. Coca-Cola yesterday just announced, right? Their bottling group is seeing the effects of inflation start to happen, right? I do think that this is going to be somewhat short-lived. I really do. I really think this is just because of the reopening. Vaccines get rolling out. We somewhat get to herd immunity. We will see, I think, some bumps in inflation. And I think people might want to know, what are we doing to combat that in our portfolios, right? I think that yeah. So
what does it mean to me?
Right. So right now, typically some of the best ways to combat that and things that do well in inflation, right, are equities. Equities actually do well when there is a rise in inflation. So right now, it's a typical 60-40 model portfolio is actually 64% equities. We have an overweight to equities, right, from fixed income. We allow some of our active management within fixed income to navigate these inflationary periods for us, right? Whether that be with areas of the bond market that have less exposure to inflation, that could be in tips, right? Some of our active managers use Treasury inflationary protected securities within their mutual funds that we own for you guys. Another way to combat that is high yield as well. High yield bonds typically are very correlated to the equity markets, okay? And if inflation, we're seeing a reflation trade, which is a rise in interest rates with a rise in GDP. This is the fastest GDP has ever risen in 40 years. So we're starting to see a reflation trade. So that, again, inflation, it's sort of a scary term. And as Rick alluded to back in the 80s, and the 70s, inflation was massive. But I don't hear anybody complaining about getting a sub 3% mortgage rate on their house when they refinanced last year. So there are positives, there are minuses, right? You might not be getting the yield that you want in your fixed income portfolio, but you're saving money somewhere else, right?
It's the obvious segue into another topic on the same question that actually has got the most questions we've gotten ever on any one of these kind of events, which is crypto. I like to hear from each one of you on crypto, starting with Andrew, because, and let's try and keep our answers to like 2 minutes or so, because we could talk for hours about this. I know we've been talking about this for 5 or 6 years through our regular and quarterly investment committee meetings, bringing in experts from gigantic organizations to educate us. So what's our position on crypto? And a little bit more specific, and you guys can answer any or all of this, but there are investors across the broad spectrum of wealth and age that are interested in this topic for themselves and or their family members. What kind of general advice, and obviously we always say bring it one-on-one, but what kind of general advice in this kind of forum can we actually give people that might be meaningful?
Yeah, so I mean, crypto, right? It's digital currency. It's decentralized. It's unregulated. It's basically digital gold, right? People are using it as forms of payment, and I just think, me personally, my thoughts on it are, there have always been barriers to entry to get into it. It's always cost a lot to get into, and there's always been a premium, right? What it's actually worth and what you're paying for it. There's a premium to the net asset value. There are more ways to get into it nowadays. My problem is that there's just too much unknown. There's too much volatility. And I think the fact that it's still unregulated is a massive problem. I think that the best part of cryptocurrency is actually blockchain. What is behind it, keeping a ledger of Bitcoin or Coinbase, whatever it might be. I think that is extremely important. And we're actually starting to see central banks around the world actually attempting to digitize their currency, which I think is the next step. Kind of have it in the form of Venmo and PayPal now with US currency. But as of right now, I think there are too many unknowns, at least for me, with crypto.
Let's go Jason next.
Okay, you know, we've studied. We had a client back when crypto first went to 20,000 before it retracted to 3,000, and then subsequently went to 60, and has recently retracted to about 55. But we had a client who said, "You guys need to understand this and be advising your clients about it." And we said, "All right, that's good advice. We'll understand it." So we went to school, started studying it. I have a really good friend who I do some backcountry skiing and mountain climbing and stuff with, and he's in the crypto business and has been. So we had him in to talk to our firm, and we started studying up. It's like, it's Pandora's box. I mean, you know, there's just a lot to it. It's very complex. So we're not professing to be experts on crypto by any means. That said, I own a little bit. And I think it's reasonable to say this blockchain technology and cryptocurrency in general is interesting enough that it could justify a 1 or 2% position in my portfolio. If so, if you want to do that, we can do that for you as a custom restricted position in your portfolio. I would caution you against that. Some of the smartest people I've ever heard talk about investing in the economy have said, if there's ever a bubble in this world, it is currently right now Bitcoin and crypto in itself, because the application of blockchain technology, as Andrew said, is amazing and could literally change the way we see money in the next 5 or 10 years, the way we use money totally. But is it going to be represented in the price of Bitcoin? It's like the internet is an amazing thing. It's changed the way we all live, unquestionably, over 25 or 30 years. But do you make money because you own the internet? No, you make money because you own the companies that are utilizing that awesome technology to foster better business. So that's my fear about the current price of crypto, is that it's like you're able to actually own the internet with crypto, right? You're owning that, but is that really going to be, and I'm not saying I think it's going to go down. We're not saying we think it's going to go up, because trying to predict the market and the price of that would be way more risky than going to play Vegas roulette, and at least Vegas roulette you get free cocktails. So I don't think we're going to do that, but it's interesting. And there are ways. One more bit on that is there used to be these dramatic premiums, as Andrew mentioned, that existed in the publicly traded closed-end funds that initially came out and offered Bitcoin. They were closed-end funds, not a great structure. There's a premium versus a discount. They're expensive. It's not a great structure. But now there's also ETFs that track the actual Bitcoin price. So they can also trade at a premium or a discount. But what's happened is some of those closed-end funds that used to trade at 25% premiums, and most of the general public buying those online on their Schwab account or their whatever account, without the help of an educated advisor who understands it, were literally buying it thinking they were buying Bitcoin at Bitcoin's price, but they weren't. They were buying Bitcoin at a 25% premium. Well, guess what? That premium has completely gone away, and now they're actually trading at discounts. And the reason why they're trading at discounts now is because there's new product coming out, competitive supply, that is making owning Bitcoin easier, and you can actually do it in an ETF, which I think IPO'd this week. There's now 2. So,
and Coinbase too, right?
Yeah, and Coinbase also IPO'd. So it's a fast-moving, radically complex space, but also sincerely interesting and potentially globally disruptive to how governments, human beings use money, because it's an unmanipulatable. You can't manipulate the price. Governments can't manipulate that currency. And so it's interesting. But
Jason,
yeah,
I think I'll give you just a viewpoint from another generation.
Sure.
Before you put a lot of money in Bitcoin, ask yourself a couple of questions. First, I'm going to put 5,000, 10,000, 100, whatever you want to put a number. If it's gone tomorrow, am I going to feel bad? And if you say, yeah, I'm going to feel terrible, well, then don't do it. The other question might be, are you interested in going for a 1-hour aerobatic flight in maybe an F-18 and see if you get unwound by one of the flying angels or those pilots? And if you say, oh, I'd love to jump in and do that, then maybe you should put a couple of bucks into Bitcoin. But for people that are my age and maybe approaching retirement, it's probably not a great idea. But it could be a great idea if it works. But if you're
So
not
again,
into speculation,
so you're saying, look, if you're going to invest in it, be willing to lose it all. If you're going to invest in it, be ready to ride the magic mountain roller coaster that does multiple loops and flips, and do it with a small portion of your portfolio. Don't go plunking 25% or even probably 10% into the portfolio. Although I think it is totally worth continuing to study and research and understand it, because the technology behind it, blockchain, is something new that is disruptive.
summary. It's perfect summary right there.
I think another way to answer the question for people that know us and maybe don't know us as well or don't know us at all on this call, and Andrew, back to you for a moment here. I know, Jim, you probably want to weigh in on this topic, but when we make a decision as the investment committee to replace or adjust a position within the strategies, for example, the asset class of emerging markets, which is actually what I use as my metaphor with my clients, with the double backflip roller coaster magic mountain experience that I love, for real and metaphorically, but my wife hates, so but like emerging markets, take that example. When and how would Bitcoin become an asset class and an IDA investment strategy?
It's a good question. Again, back to the fact that it is unregulated, right? It's completely decentralized, and I'm not saying that fraud doesn't happen even when things are regulated. Just look at the WorldComs and see, Enrons of the world, right?
Right.
Again, I think there's too much unknown right now about it to make its way into the investment. And I think if there's anything you're going to think about, is it actually doesn't produce anything, right? It's like gold. It's not like a stock or a bond that gives you a future cash flow, right? Or earnings or a dividend, right? This produces nothing. It produces pure speculative driven pricing, just like gold. Again, someone could be laughing at me and saying, well, I've got my Bitcoin's worth $52,000. Well, I woke up Monday morning and it was down 20%, right? So I don't know how it would work its way into it unless it was completely regulated.
Yeah, and or an easier way, more transparent way to buy it and trade it.
Right.
Yeah, and so on and so forth. So good answer.
I will say one thing too on it is that around this time last year, most of our conversations were much more somber. And so for most of the conversations today, or around this time of year at least, to be talking about Bitcoin and blockchain, that's nice to reflect on for a moment, right?
I think something that Jim says a lot that I really like and have adopted from Jim is that when it's interesting how people now are talking about risk on positions. The market's at an all-time high, and we have more interest in risk on positions than ever before. And Jim uses a statement like when the markets are great and strong and high, people are unbelievably courageous. When the markets are low and depressed, people are unbelievably scared, right? And so I think that it's true. And I think we have to be careful as investors to not chase that. I mean, SPACs was a question that came up, talking about these SPACs, and it's a new way for public investors to invest in IPOs, and we don't invest in SPACs right now as a company, and we have some knowledge about them. The problem is some of them can be very good and interesting, while other ones are literally people raising money for a company that does nothing, has no products, has no revenue. It's a business plan. And you're investing in a business plan from people you don't know or understand, where they have total free reign of the money you invest. So to me, SPACs is just another term and another way for creative Wall Street folks to sell stuff to the unsophisticated investors. And so we don't see a need right now to invest in those or even deeply understand them, because we know that There are great publicly traded companies that are going to produce goods and services and sell those for a profit. We know there are great publicly traded companies and institutions that want to borrow money, AKA buy bonds, and we can make a good revenue on those and income off those. We don't have to go chase these ancillary, obscure products to try and find a good rate of return. And most of the time, I'm sorry, all of the time, if something sounds radically too good to be true, and if it seems phenomenally interesting where you're getting a 15% rate of return and there's no risk, something's wrong. There's part of the story is missing, because there isn't a free lunch out there that hasn't been discovered that we're holding back the secret on, or anybody else is. And most of the time it's disguised as a beautiful new thing, and it's probably not a great product in one way or another. So I just wanted to touch on SPACs real quick, because I know.
Yeah, we've only got 3 minutes left. I know the last part is for us to cover how to prepare yourself for the next market event. Because guess what? There's going to be one, and we should all be so fortunate to live long enough to see many market events, right? 2 minutes, guys. That means 30 or 40 seconds each, please.
Balance your balance sheet, stick to the discipline, take the long-term outlook. And again, it's the math's the math. It takes the emotion out of it. These SPACs, these cryptocurrencies are speculative. And we've always had a rule of thumb. If we can't get it's kind of a Warren Buffett. Why was he so adverse to technology? Because he didn't understand it. If I can't understand it and I won't invest my own money in it, we're never going to invest our clients' money. So there's a lot to be learned. I think Jason and Andrew had a lot, and Rick had a lot to say that were spot on as it relates to crypto and SPACs. And, that doesn't mean that change is permanent, right? So that doesn't mean that can't change, but right now it's highly speculative and not a place for most of our clients' portfolios, and it certainly is not going to leak into our model portfolios at this time. We have the facilities to be able to get you exposure if you want to do it as a one-off out of the model portfolios, but caveat emptor, buyer beware.
Yeah.
Thank you, Jim.
We have so much fun in the financial planning process. And it's what really changes. The best stories that I hear from our clients are, I've had an advisor for years and years and years, and this comes from multi-million-dollar, $5, $10, $6, $15 million, $2 million, $800,000 clients. And we go through the comprehensive and interactive financial planning process. And they say, I've never had anybody do that. I've never understood the whole piece of the puzzle, which what happens then is it creates the ability to free your mind and truly think about your purpose. Why are we here, right? It's not about a risk tolerance, finding how much risk you can tolerate and then develop a portfolio that's going to eventually give you that sleepless night and gut wrenching pain of the maximum risk you can tolerate. That's not it. It's about figuring out what's your goals and what's your purpose and what do you want to do, and then showing you the needed rate of return to accomplish those goals, and then making sure you're comfortable with the associated volatility. It is a beautiful, peaceful process that works. And so I think that we're just so grateful for the trust and confidence, and I'll close here, but we're so grateful for the trust and confidence that our clients have given us. We don't take it lightly. We work together under the collective knowledge of our team. We challenge each other. We debate. We do this in our investment committees. We have BlackRock on our investment committee, the largest investment firm in the world. We have the most academically robust investment company in the world, Dimensional, on our investment committee. We're challenging ourselves and challenging our portfolio and thought process every day. And we thank you for the trust and confidence. I'm not closing out the whole webinar, but that's my last statement, is just thank you. And we're honored to do what we do for you. And we will keep doing it. We will keep learning and keep fine tuning and getting better and better as we go.
Right on. Rick, how about you? What do you think investors and listeners should be doing to prepare themselves for the next big event, whatever that might be?
Relax and enjoy today. We're watching over the portfolios. Get somebody to help you, and know that there are going to be some difficult times. There are going to be some good times, but enjoy your family, enjoy your day-to-day life, and the world's going to keep going around for a while.
That's good. Andrew?
I think you just take it back to lessons learned. You just stay the course. You have a financial plan that will show you what happens in market scenarios like back in March and April of last year. Although potentially scary for people that might be looking at retirement that year, which we have to understand what their emotion is with that, right? But again, stay the course. You have your plan. You plan for events like this and more to come. There'll always be one. It's never going to go away.
That's right.
But can I add on that, Andrew, because that was so well said. I'm sorry, I thought I was going to be done, but you don't have
inspired you.
He did. He's inspiring. You don't have to be subject to a lot of volatility. That's the thing that's amazing is most clients that are worried about timing this and getting to market and should I be in SPACs or should I have crypto, they're needed rate of return. The rate of return they need to accomplish everything they want is oftentimes 3, 4, maybe 5%. So the point is, you don't have to have a very volatile ride. You don't have to ride the Magic Mountain roller coaster. You could actually most likely accomplish your goals and financial purpose on the Legoland roller coaster, which is really chill and fun. So
Teacup ride.
Teacup ride, right? You can have a peaceful, successful journey. You don't have to be exposed to stock market volatility of the NASDAQ and technology and the S&P 500. So that's what the planning process does. And it brings it all back to your goal, your purpose, and what do you need in a rate of return. It doesn't have to be a wild and volatile experience just because we know there's going to be another downturn in the future.
I'm scanning our questions from the attendees. There's a couple more. I know we're out at the time that I allotted for this, but whoever wants to stay on, I'd appreciate, let's hit them while we have them. We've got, this is an interesting one. So explain sustainable funds and ESG, and if IDA looks at these or maintains traditional investments.
Yeah, I can be happy to answer that question. Sure. So with some of the funds that we have in our models, right, our actual positions, we can actually show you what the ESG rating is based on its peers, whether that be peers in a specific index or asset class, right? So we do look at that, and some of the scores are very good. Not every single position is based on what is their ESG rating, but it is taken into consideration. It's been a very big topic of discussion starting last year, really. It really ramped up last year as it relates to just a model that has all ESG funds, not something we currently have right now, mainly due to lack of client requests probably. But it is absolutely something that is built into our portfolios currently, and we can show you those scoring methods anytime.
Is one way to answer the question too, like ESG and sustainable investing is not black or white. It's kind of like different shades of gray.
It's hard, I think back, people didn't want to own tobacco stocks or cable company stocks, but they were happy owning Morgan Stanley, which financed all those kinds of companies, right? So it's what is a trickle down effect and how much are you really attaining in the ESG level? But no, again, we kind of look at it in a way as it relates to other investments within that category and how well those are scoring.
Yeah. Anybody else? No? Okay.
Andrew
Next one.
killed it.
Yeah, I echo everything Andrew says.
Yes.
On that topic. This is an interesting one. It's written like this. It seems that the efficient market actually responds to societal emotion as a sum of individual emotions. How is this efficient, and which would be based on fundamentals?
Sounds like a Reddit trade.
I was going to say, it makes me think about the GameStop thing a little bit, right?
The retail investor is back. It's a real thing, the retail investor, without a doubt. People need to pay attention to what is going on in retail. Unfortunately, I think a lot what people saw on the retail side as it pertains to trading in AMC or GameStop, right? I think we all knew those companies they just were not doing well, right? And people picked off short positions, and it's real. You have to pay attention to it. Unfortunately, what they were trying to do is try to score a point for the little guy, where the ironic thing about it is the companies that were short that, they actually manage money for pension plans that I guess people might say are the little guy, right? People working at the Ford factory, right? They are managing their money, and they're actually short GameStop, that hedge fund. So it's funny how a lot of these people kind of tried to conjure up a way to get back at the man. But I think the retail investor is around, and it's something that needs to be paid attention to.
I would add to that to me, and maybe this differs a little bit. To me, it's like you have you're at a great event, and it's a sideshow circus. It's completely and totally irrelevant in a well-diversified, totally allocated portfolio, tied directly and tailored to somebody's individual financial plan. This sideshow circus that's all it is. Watch it for entertainment purposes only. Buyer, I think I personally think it's a sideshow circus. So it's not something that we should be focused on or spend any time or energy on, because it will have no measurable impact on our clients over the long term and their financial plan and their total asset allocation. Although I believe Andrew's totally right. It's a significant movement, but really in the grand scheme of our clients' portfolios, financial planning, it's a sideshow circus.
It typically pertains to single stocks, which is not
Right.
something that you will probably have in your portfolio with us unless it's a restricted security. So it shouldn't have too much effect on you specifically.
Maybe just to reinforce our investment philosophy in itself.
One more quick thought that's maybe worth, there's an interesting Bloomberg article that came out here the other day talking about severe deflation. And when everybody is talking inflation, I would just say you might want to actually think about the opposite of what the herd is talking and thinking about, and think about deflation. Some people that I've heard speak have made arguments that were very compelling to me that said we might have a bigger chance of deflation on the next 5 or a couple of years, 1 to 5 years, a bigger chance of deflation as compared to even inflation. So again, going back to the theme of, if you're diversified and you own a great portfolio and you're constantly making small tweaks to that portfolio based upon what's going on in the global macroeconomic environment, not timing it, but making small tweaks, I think we'll be prepared for whatever environment comes. But I wouldn't personally be surprised to see that the next bigger issue between inflation and deflation that we end up facing is potentially deflation. Just as a complete and total counter thought to all these people talking about inflation. It's like, I can think back to it was about 4 or 5 years ago. I had a group of friends and we played poker, and a couple of financial advisors there. And one financial advisor there, I remember in particular, told me how he was totally set. Inflation was coming. He had all of his clients ready for inflation. This was 5 or 6 years ago, right? And I'm like, wow, how do you know? He's all, I just know, I read some articles, I studied it. I'm like, I think you're the only person in the world who actually knows what the market's going to do, versus, because you said with 100% confidence. And he clearly didn't know, and he was clearly wrong. I can think back to advisors and people talking about how the market is at an all-time high and we can't go higher and we need to be short and we need to get out of the market 5 and 6 years ago. And look at where we are today from there, and even 2 years ago and 3 years ago. So again, it's about building your plan and building the right globally diversified portfolio that's going to help you extract rate of return that you need to accomplish your true financial purpose. How fun and how peaceful. And it works so well. So, yeah.
Great. We're 10 minutes over. Thank you all for panelists. I appreciate it. Jim, Andrew, Jason, Rick, thank you for your time and your great dialogue and conversation. There's a lot of demand for this. I know a lot of people weren't able to actually attend live, so I'm speaking to you. We will record, this is being recorded, so we'll send it out to you and you can distribute it. I am forced to read a disclaimer at this time. You don't have to listen to it.
You do have to listen, Alex. Jordy would say you have to listen.
Okay, you have to listen to it. But before I do that, is there any closing comments that any of you guys want to make?
Simply thank you.
Thank you.
Awesome. Okay. Here we go. The content of this program is provided for informational purposes only and should not be considered investment advice or recommendations to buy or sell any types of securities or cryptocurrency for that matter. The panelists are not responsible for the consequences of any decisions or actions taken as a result of information provided on this webinar, and do not warrant or guarantee the accuracy or completeness of the information provided. The information discussed today reflects the views of the panelists as of today. And are subject to change without notice. Past performance is no guarantee of future results. Any forward-looking statements or forecasts are based on assumptions, and actual results may vary from any such statements or forecasts. No reliance should be placed on any statements or forecasts when making any investment decision. Accordingly, attendees should not rely solely on the information provided today in making any investment decision. That's the disclosure. What it really means is just come talk to us if you have more questions, and we'll help you.
Yeah, I'm still sticking to my story.
Right on. All right. Thank you, everybody.
Thank you.
Thank you.